Welcome back to the Am I Rich Yet podcast, a weekly podcast where we help millennials and Gen Zs spend, save, and grow their money smarter. Welcome to today, episode number 15. Today, we are going to be talking about investment rules to live by. My name is Georgia. I'm one of your co-hosts. I'm a Gen Z, currently completing my MBA in Sydney, Australia, and navigating my personal finances.
I'm Rob, Georgia's dad, recently retired financial advisor, and I'm here to help you make smart decisions with your money.
There we go. Dad?
Georgia, how are you?
Do you have your question of the day prepared for me?
Who's your best friend?
Oh, that's a crazy question to
Now,
ask
understand,
live.
Georgia's got like 3,000 followers on her Instagram. Friends have always been her middle name. Even when she was a little kid, she had this little group of mismatched people. And they were all from different games and things, and she would just carry them around, and she just called them my people. And here she is, 26, and she still has her people. So it's kind of interesting.
Okay, well, you just asked me a crazy question that could get me into some trouble in paradise in certain relationships. So I'm going to do a couple things. I'm not going to choose either one of my parents because you two are standing right in front of me and I can't get favorites. I'm not going to choose any of my girlfriends. I'm also not going to choose any of my male friends. And that leaves me with one obvious choice, which would be my sister. Now, Eric and Lily are tied as my best friends, but because Lily and I are both gals, I'm going to go with Lily as my best friend. So hopefully she's listening to our podcast.
So if you ever get married, she'll probably be your maid of honor, I would guess. What about me? Any questions?
My question for you today is, what is your most memorable trip? And you can think maybe it was one of the first trips you ever went on solo. Maybe it was a trip where you got to do something really exciting. Maybe everything went wrong on the trip and that's why it's memorable. But most memorable trip.
I'm going to say the most memorable trip that immediately came to the top of my head was probably going to Hawaii for the first time. And it wasn't that long ago because it was a long flight, young kids, and it just didn't make sense. And it was expensive. I had just come through cancer treatment and I had my energy back. I was still really thin, but we just had so much fun. We did some great hikes, great restaurants. We did the helicopter trip, and it was so memorable. I just remember being able to pull over the side of the road and there'd be someone who could teach you surfing, and it was really cool. So that was probably my most memorable trip.
That's a great one, and I mean, the stage of life that you were at that time is probably what made it so special as well.
Absolutely.
Well, let's jump into it. I introduced the episode by saying today we were going to be talking about investment rules that you need to live by. And we had a lot of questions around investing, and that's why we're talking about this. So I want you to kick it off here and tell us what investment rules we should be living by.
I'm going to call them Rob's rules to live by. These are the things that I've picked up in my 30 plus years as an advisor. And financial advisors have a big advantage because they often have multiple clients with the same portfolio. You know, we typically had 7 different portfolios, but I would have 100 clients all using the same portfolio. And it was interesting, you could look at their 10-year returns and the returns would be different. And what you learned from all of that is they had made mistakes along the way. They had stopped saving. They had asked you to move to cash. They had asked you to move to a more conservative portfolio. All kinds of little mistakes show up in your returns down the road. They had asked you to buy an individual stock or something like that. And never did it come to their advantage. It always came to their disadvantage. If they'd just stuck with the basic portfolio, stop playing with it, stop playing with the bar of soap, they would have done great. So that's the example of why advisors have an advantage. They get to see the impact of everything. So, number one, and it relates to what I was just talking about, just stick to the strategy. Take a road and keep going down that road. If it's a good road, it will eventually be a great road and you'll get great returns. If you keep trying to change lanes because you think you're in the fast lane and you see the middle lanes moving faster. You switch over to the middle lane. The problem is 10 cars did the same thing in front of you that you didn't see. And so now the middle lane's the slow lane. And you're better just to stick to the lane. You're not likely to have any accidents when you stick to the one lane. And those that keep moving, they don't really get further ahead unless they're endangering their lives or someone else's life. So stick to your strategy. There's going to be times where your strategy will be underperforming. Don't leave it. Don't leave it, unless it's a stupid strategy and not a diversified strategy. Number 2, avoid individual stocks. Unless you're an expert at picking stocks, and remember, even the experts underperform the market, avoid picking individual stocks. Yeah, it's fun. It's good for cocktail parties and talking to friends. Oh, I bought NVIDIA when it was $10 a share. The reality is what you're not telling your friend is the other 9 stocks that you bought that you lost your shirt on. If you want to increase your level of risk, move to 100% equity. If you want even more risk, add a little bit of leverage in. Don't start going and picking individual stocks. No one's good at it. No one at all. Even picking individual mutual funds, no one's good at it. Quick story there. We made the transition to passive investing a number of years ago. And one of the things we did before that move, we talked to every mutual fund company that we'd been working with. And I said to them, who is the best at picking individual mutual funds? And they said, frankly, Rob, and they all said the same thing, none of the advisors are any good. You all are like lemmings. You all move to the same thing at the same time. And it's always the wrong move. So that's the lesson. Number 3, diversify around the world. We've touched on this more recently, diversification in the last thing. The world is huge, and there's so many opportunities around the world. So diversify around the world, including emerging markets. There's some great potential there. Does it always work? No, but diversification does work. For the last 10 years, the US has been the rage. It's 60% of the world's stock market today. But understand that 10 years before was called the lost decade because it dramatically underperformed. So you need to have everything in your portfolio. Number 4, my take, and I used to work for a company that believed in active management for the longest time, and they're finally sort of switching over. Avoid active management. It's expensive and it underperforms over time. And the reason is not that they're not intelligent, it's just they can't predict the future. No one can predict the future, and they're competing against the pros. You've got Connor McDavid competing against Sidney Crosby. It's tough to come out ahead. It really is. You're competing against other pros around the world who are managing money. They may have more information, less information, whatever it is, more experience, less experience, more analysts, less analysts. It's really difficult. So avoid active management. Next up, don't trade, just rebalance. Stop trading, rebalance. Sell from the areas that have done great, take some profits and put it into the areas that have done poorly. That's rebalancing. You're selling high and buying low. Here's a story, George. A client comes to me and I say, we're going to rebalance your portfolio. We're going to take some profits in the US and we're going to put it into Canada. Canadian companies versus US companies. And your response will be, the US is doing really well right now. Why would I want to do that? And I go to them, when's the best time to buy an investment? Georgia, when's the best time to buy an investment?
Yesterday?
When's the best time? When's the best time to buy an item of clothing? When's the best time to buy an item you want to buy?
When you have money.
No.
When interest rates are low.
When it's on sale.
When it's on sale, when the price is low.
So that's what rebalancing is. You're buying things when they're on sale. Even though you don't know why they're on sale, and eventually they'll come back. Next up, know what fees you're paying. Fees are really important. So understand what fees you're paying to whoever you're working with. If you're in an index fund, you're with a robo-advisor, you're with a financial advisor, you're with a bank, you are paying fees. There's something that's paying for their business. Understand what those fees are and make sure it's reasonable. We talked about investing monthly. It's the easiest forced savings plan you could do. You're paying yourself first. We've talked about how important that is. You're the most important person in this whole equation, so pay yourself first. And every year, increase it. Every year, increase it at least with inflation and in line with your income. Taxes. Taxes don't get enough attention. And to me, money saved in taxes is just as important as the rate of return. So here's two examples. One, someone has an 8% 10-year return. Someone has a 10% 10-year return. But the person with the 8% return saved $10,000 a year in taxes. The two are probably even. Taxes are important. And it's not just whether you get a tax refund or not. What it is how much did you actually pay the federal and provincial government in taxes on your tax return? That's the number. It's not whether you got a refund or you had to pay. People will get angry because they have to pay taxes. And I'm like, well, that's okay. If you got a big refund, it just meant the government was sitting with your money for the whole year. So we'll talk about that when we get to tax strategies. Number 9, we've touched on this. Put as much equity in your portfolio as you can handle, as much. If you can get up to 100% equity, all the better. If you can only get up to 80%, that's still really good. If you're at 60%, you gotta push yourself forward. You'll never get ahead of taxes and inflation. Next up, number 10, be patient. It's tough. In my early days as a financial advisor, my client would come in, they'd be unhappy with investment A, and they were happy with investment B. So of course, I always thought my job was to make my clients happy. So I would move money from investment B. And 5 years later, we'd look at their total return and it wasn't very good. And it was because I wasn't being patient. I wasn't giving good advice. I was doing what the client wanted me to do. What I realized is my job as an advisor is to do what's right, not what the client wants me to do. Okay, now that's tough sometimes. I remember a funny story. I had a client and he had over $1 million in Nortel. And this was when Nortel was the biggest Canadian company in existence. Its stock was through the roof. And I said, we need to get money out of this. And he wouldn't, and he didn't. And he turned that into basically $100,000 by the time he sold it. We had a meeting after it had gone down to the 100. And he said, you weren't forceful enough with me. And I said, did I need to jump over the table and wring your neck? Like, I told you 6 times, 6 different meetings, we needed to take profits on this. Good things always come to an end. That's just life. You got to be patient with stuff. Next up, bonus. This is my number 11. Never stop your long-term savings plan. Never dip into it unless you're buying an asset. If you are, and if it's your house, don't dip into your long-term savings plan to buy a bigger house. If you're buying an investment property, a cottage, farm, that's perfectly fine. Don't do it for lifestyle expenses. Moving to a bigger house is just a change in your lifestyle. Long-term savings should never be touched, and your investment should never be touched unless it's for another investment. If it's for a lifestyle change, that's a mistake, because a more expensive lifestyle, you're going to need more money to retire on. So if you start spending more money on your lifestyle, you're actually going to need a bigger pot of gold at the end of the day. So that's it. That's my 10 plus 1 bonus.
Now let's list them off top to bottom.
Number 1, stick to your strategy. Number 2, avoid individual stocks. Number 3, diversify globally. Number 4, avoid active management. Number 5, don't trade, just rebalance. Number 6, know what fees you're paying. Number 7, invest monthly. Number 8, focus on your tax bill. Number 9, have as much equity as you can possibly handle. And number 10, be patient. What I want you to do right now is just give yourself a check mark for all of those that you're actually doing today. And if your score is less than 5, you need to make some changes. If you're above 5, you're 6, 7, you need to tinker with it a bit. If you're down to 1 or 2, you need to make some big changes if you want to build true wealth.
These changes are practical and doable, and anyone can do it to their investment portfolio. That takes us to the end of episode 15, Investing Rules to Live By. And next week, what are we going to be covering?
Next week, we are going to be covering buying your first home.
We had a ton of questions come in around home ownership, how to get your foot in the door, and we're going to be covering all of that. So thanks for tuning in today, and we look forward to seeing you next week.
See you next week.